Hello and welcome everyone to Gold Asset of the Day for the 22nd of June 2022, presented by myself, Phil Carr, at the Gold and Silver Club. So as we head into a new week here, we have gold still stuck in a range between that 1830 level up towards that 1840 handle. Now, hedge funds and money managers in the last week, they have reduced their overall net long positions on the metals, especially in the lead up to last week's FOMC statement. Of course, afterwards we saw that slingshot move higher for gold, a 500-point breakout, taking gold up to 1,857 US dollars per ounce. In fact, with our clients at the Gold and Silver Club, we took the opportunity to bank 2,000 points profit on natural gas and also 500 points profit on gold after the FOMC statement last week. So just quickly, for that calculation, every one lot contract you'll be trading, that's $25,000 of profit. Every 10 lot contract you'll be trading, that's $250,000 of profit. Now, going into this week, it's very much the same for gold. Range-bound volatility, yet again, that's really the name of the game at the moment. I would look at, over the course of this week, and gold right now is trading at 1,834 US dollars per ounce. I would look at the potential for gold to yet again pull back and roll over back down towards that 1820 zone of liquidity. So any moves really back down towards the 1800 zone, we are interested in yet again snipering in and buying right at the lower end of the channel. Again, that 1820 down towards the 1800 zone on gold, I perceive as the area of liquidity, the zone where we're interested in accumulating further exposure. And then it's really a case of capitalizing on a very fast slingshot moves higher that we keep seeing time and time again. 2 weeks ago, it was the CPI data, which caused a 500-point breakout to the upside for gold. Last week, it was the FOMC statement. Again, another 500-point breakout to the upside. I would also keep an eye on silver here as well. So we've got silver, major zones of support right now. They reside at 2150 down towards that 21 US dollar per ounce zone. These are really the areas of interest for us at the moment. Now, with respect to the ratios in the market, the silver to gold ratio is showing silver outperforming gold over the course of this month, and the copper to gold ratio, that is also demonstrating that copper is set to outperform gold over the course of this month. So I would keep an eye on that moving forward. We have the dollar index, which is starting to roll over and come off the 20-year highs, which were hit last week off the back of the FOMC statement when the Federal Reserve increased interest rates by 75 basis points. As a result, that actually put in the low for a lot of markets last week. Since then, we have seen a relief rally to the upside, some opportunities to capitalize certainly on the bounces on the metals and the energies over the last few days here. So really the game plan for this week, an expectation is more range-bound price action, but opportunities to accumulate on revisits back down towards the lower end of the ranges. Now, another point to be aware of at the moment is as we transition into next week, it's going to be the end of the month and also the end of the quarter. The following week after that, we also have the Independence Day holidays in the USA, that public holiday. Markets over that period, they can often be more volatile due to less liquidity in the market. And this is where you can get exaggerated moves. So it's just worthwhile being aware of. So let me repeat that. Going into next week, we have the end of quarter profit taking, which will potentially see capital flow back out of many markets as traders are booking profits for the end of the month and the end of the quarter. Then as we transition into the following week, we're going to see public holidays in the USA. Obviously, we have the minutes of the FOMC in the first week of July and also the Friday's non-farm payroll data as well in the first week of July. All of these can set up for explosive moves, more volatility in the market. Remember what we stated previously. Make sure that you're being nimble in these markets. Commodities, they don't go up in a straight line. They will zigzag, and this gives you opportunities regularly to bank into strength, to reload at the lows and repeat the process. It really is a trader's market right now, and you want to capitalize on the day-to-day volatility in these current markets. As you know, trading is a skill that makes you recession-proof, it makes you inflation-proof, and if you learn more, you will earn more. So definitely want to ditch those outdated, gimmicky technical indicators and technical analysis. If that is all you are relying on for an edge in these markets, you'll just end up getting crushed and you get chopped up all the time in these current market conditions, where you want to be utilizing a research-driven approach. This is where you want to be utilizing data, statistics, market intelligence, layering in each step of your process to give you edge for every single trade that you are taking, learning the fundamentals, the macroeconomics, the geopolitics. Alongside that, the key areas of liquidity, the capital flows, and the daily, the weekly, the monthly, the quarterly cycles for each commodity. And of course, alongside that, how the hedge funds, money managers, banks, and institutions are positioned in the market, that will help you massively to get an edge. So with that, if you would like to join our community of successful traders, learn the research-driven approach to the market, and join our professional mentorship program, there is an opportunity for you to do so. Just make sure you click in the link below today's report in order to make an application to join our professional mentorship program.